What's the best time frame to trade? 4 hour, daily, 1 minute? Here's the truth. It doesn't matter. Any time frame works. Seriously. Why? Because the market is fractal. Price moves the same whether you're looking at a weekly chart or zoomed into a 5 minute. Today, I'll show you exactly why time doesn't matter. As long as you follow the right concepts, market structure, imbalances, and supply and demand. Stick around, because at the end, I'm giving you my top 3 entry models. The same ones that can boost your win rate, slash your losses, and completely flip your trading game. Let's go. Let's kick things off with the weekly chart. Here's what we're looking at. The GBP/USD chart. The market has broken structure and made a new higher high. There's an imbalance, a price gap that price often wants to revisit. And just below that imbalance, we've got a clean demand zone, the last candle before the impulse up. So what does that mean for us? If price pulls back into this zone, this could be a great buying opportunity. And where would we target? Simple, the swing high. Why? Because we're in an uptrend and prices often want to clean out previous highs. This setup gives us a 3.45 R trade. That means risking $1,000 could return $3,450. Now, of course, this is the weekly chart, so yes, it's going to take time to play out. But here's the point. Watch how this exact setup repeats across all time frames. Now let's move to the daily chart. And this time, we're looking at the US dollar index, a totally different asset. And guess what? Same story. We've got a break of structure to the upside, an imbalance, a price gap, a demand zone just below the imbalance. We're looking to buy from that demand zone, with our stop just under the low and our target set at the next high. This one offers a 3.25 R trade. Risk $1,000, make $3,250. And it plays out beautifully. Tap into demand. Strong continuation to the highs. Same concept, different assets, different time frame. Now let's step down to the 4-hour AUD/USD chart. Here we go again. Break of structure. Higher high imbalance left open in price demand zone just underneath the imbalance. You already know what's coming. Buy from demand. Target the swing high. It's the same trade idea, but faster. This time, the move takes only a few days to complete, and it gives a juicy 6.5 R return. That's $6,500 for every $1,000 risked. This is where swing traders start to get excited. All right, let's go micro. We're now on the 5-minute chart. Do the rules still apply? Absolutely. Structure shifts, bullish imbalance appears. Demand zone lies just below that imbalance. You buy from demand. Stop goes under the low and target the recent high, just like we did on every other time frame. See the pattern yet? It's all the same. The only thing that changes is how fast the trade plays out. Okay, now for a bit of fun. Let's jump down to the 30-second chart. Yes, I said 30 seconds. Now listen, I do not recommend trading this time frame. It's chaotic. It moves like lightning. But watch what happens. Higher highs and bullish structure. Imbalance shows up, demand zone sits just underneath the imbalance. Same entry, same target, same logic. This setup gives you around 2.85 R. Not amazing, but it proves the point. The concept stays the same. So what have we learned? The market is fractal. And if you master price action, structure, imbalances, and demand zones, you can trade on any time frame. Weekly, daily, 4 hours, 5 minutes, even the 30-second. Though I hope you don't. It's not about the chart. It's about the concepts. So now you've learned how to take a trade. But what you probably haven't learned yet is the entry model. This is what helps us spot fake demand and supply zones. And more importantly, it helps us reduce risk. Here's the real game changer. There are 3 mechanical entry models that can completely transform your trading. Once you start using them, you'll not only become more profitable, you'll also be able to filter out the fake zones with confidence. Why? Because these entry models don't appear in fake zones. They only form at the real high probability zones, where the smart money actually steps in. Before we dive into the entry model, let's first understand a key question. How many types of break of structure are there? There are 3 main types. Guys, 1. The clean impulse, where price moves in one strong direction and breaks structure directly. 2. The inducement break, where price first leaves behind a leg that acts as inducement and then breaks structure. 3. The range breaks, where price consolidates, creating something like a trendline liquidity zone, and then breaks out. These are the 3 most common breaks of structure patterns we see in the market. Now here's the key. Our entry model is built around these break structures, and it's mechanical, meaning it can be tested, repeated, and refined. Don't just take my word for it. Backtest it. See the results for yourself. And if it makes sense to you, come back, subscribe, like, and keep learning with us. That's all for now. Let's keep growing together. Here we can see a bullish trend in motion. After a pullback, price makes a clean break of structure. No inducement, no trendline liquidity, just a straight impulse. Then comes another pullback. But this time, it starts building liquidity during the retracement. Once enough liquidity is built up, price sweeps it all, and then shoots up again, creating another break of structure. Now the real question is, how do we enter a setup like this on a real chart? Let's break it down step by step. Let's do it. Here you're looking at the Euro to US dollar M15 chart. After a pullback, we get a clean break of structure. No inducement, just one unmitigated demand zone sitting below an imbalance. Now pay attention. As price pulls back, we don't take an entry immediately. We wait for liquidity to build and get swept within the pullback. You'll see the price starting to move down again after a large candle. But notice, it hasn't swept any liquidity yet. Then we get another pullback, and this time a candle sweeps the liquidity. It touches the highest demand zone and closes right around that area. That's our signal. Liquidity has been taken. From here, we shift to the M1 chart to confirm. On the M1, you want to look for a change of character. Cho CH. This is your main confirmation. Right here, we get a fractal high break, signaling that momentum is shifting. Once the change of character is confirmed, we wait for a small M1 pullback, and then that's our entry. Remember, this setup already swept liquidity on M15, which makes it a high probability reversal point. So now we enter on M1. Our stop loss goes below the causal low on the M15 chart, and our target is set to the previous high on M15. Step by step, price moves in our favor. It breaks structure again and hits our target. A clean, mechanical, high-probability trade, executed with precision. And with that, let's move on to the next topic. Let's talk about the second entry model. First, you'll notice a strong push upward, a powerful move that starts it all. Then, the market leaves behind an inducement, and shortly after, we get a break of structure to the upside. That move confirms intent, but the story doesn't end there. In that very leg, we also have liquidity sitting below, acting as a second layer of inducement. And because that liquidity exists, price pulls back once more. Then comes the key moment. It sweeps the liquidity, and without wasting any time, rockets back up with momentum. This move is clean, fast, and precise, exactly what we look for in a high-probability setup. Now let's jump into a real chart and break down how to actually take the entry. Okay guys, let's take a look at the GBP/USD M15 chart. Before taking any trade, the first thing we need to check is the market bullish or bearish? Here, we clearly see a bullish break of structure, followed by a strong bullish impulse. So in this case, we're looking for a demand zone to trade from. Right here, we've got a clean demand zone sitting with imbalance, and just above it, we've got liquidity in the form of a leg inducement. We'll mark that leg inducement. That's our FAR liquidity zone. Now watch this. The market pulls back, respects the demand zone, and starts pushing upward. That pullback also grabs liquidity from the leg inducement zone. Notice the large wick that touches the demand zone. That's key. This wick tells us there's strong buying pressure kicking in from this level. So what do we look for before entering? First, liquidity. We have it. Second, leg inducement. That's been swept. Third, it touched a high-quality demand zone with imbalance. That gives us a high-probability setup. Now let's drop down to the M1 chart to find our entry. On the 1 minute, you can clearly see a change of character. Chuck right where that large wick formed on M15. That wick itself is our signal. It shows liquidity was taken. And now price is shifting direction. So here's the important part. Since liquidity has been swept in M15, we don't wait for another pullback on M1. We enter immediately after the chalk, placing our stop loss just below the wick. Our target? The previous M15 high. Look closely. Our stop loss stays safely inside the M15 demand zone, which means lower risk. And from here, we expect a strong impulse upward. As you can see, price explodes from the entry, hits the target, and moves aggressively, all without waiting for any extra confirmation. So, let's quickly recap what you need to check. Is the trend bullish or bearish? Is there a leg inducement or not? Does the POI, point of interest, have imbalance? Is it a high-quality demand zone? Has the lower time frame shifted? Do we see a chalk? Once all of these align, you enter. Simple as that. Alright, let's move on to the next topic. This is entry model 3, and when you see it, you'll know exactly what to do. Price is in a bullish run. It pulls back, then it starts ranging. Suddenly, it breaks the previous high. But here's the twist. During that move up, a clean trendline liquidity forms. Smart money loves that. So price pulls back, hunts that liquidity, and sweeps it clean. Right after that sweep, boom. we get a clear change of character. That's our green light. That's when this entry model comes alive. It's an advanced setup, but when you combine it with the first two models I showed you, it's a weapon. All right, enough theory. Let's pull up a real chart and break it down step by step. You're looking at the real euro to US dollar 15-minute chart. First, we get a pullback. Then, price moves in a tight range. Suddenly, boom, break of structure. And you already know the rule. When BOS happens, we expect a pullback. Then, an impulse continuation. Simple market structure logic. Next, we hunt for a demand zone with imbalance. Right here, clear as day, we mark it. Before that, we also note the trendline liquidity sitting above. Now we wait. Price pulls back, touches the demand zone. Good. That's our signal to either use our entry model or treat it like a double confirmation setup. But remember, double confirmation won't show up every time. So, we check. We wait for a fractal change of character, and here it is. Pull back into the zone. Structure shifts from bearish to bullish. From there, we draw our fresh M15 demand zone. Buying bias confirmed. Once price taps that demand zone again, which it just did, we drop to the 1-minute chart. On M1, we want a bullish structure flip. Got it. Now wait for another pullback. We pull out the fib, mark 50%, set the buy limit. Stop loss goes just under the recent low. Leave a little breathing room. Price tags our entry perfectly. Target, the M15 high. Price rips up, smashes the target. Just 3 things to master. 1, structure, bullish or bearish. 2, with inducement, without inducement, or range impulse. 3, POI quality. Does the zone scream high probability? Once demand is tapped, drop to the lower time frame. Execute the entry model. If you want double confirmation, wait for fractal change of character and pull back into M15 demand. Then drop down, confirm, and set your target. That's the breakdown. If this helped, hit like, smash subscribe, and tell me in the comments what topic you want next.